Open YouTube or Twitter, and you'll see thousands of people selling the secret to beating the market. But most of that complexity is a distraction, because the data says even the professionals usually fail. In this video, we'll look at 3 ideas: what the SPIVA reports reveal about active managers, why a tiny fraction of stocks creates most of the wealth, and how an index fund updates itself without you having to guess the winners. Quick disclaimer: this is educational only, not financial advice. We'll cover 4 short chapters: the scorecard, the math, the system, and why boring is psychologically hard. And stay with me for chapter 2. There's one 4% statistic that explains why stock picking is so difficult, even if you're smart and you work hard. Let's start with the professionals. Imagine a mutual fund manager. They're paid millions. They have a team of analysts. They spend 80 hours a week reading financial statements, visiting companies, building models, everything you'd expect. Each year, Standard & Poor's publishes a scorecard called SPIVA. It compares active funds to their benchmark, like the S&P 500. Over a 1-year period, about 60% of active managers fail to beat the market. Stretch the timeline to 5 years, and the failure rate rises to about 75%. At 15 years, it's over 90%. That's the part most people miss. Investing isn't a 1-year game. Time is where the gap opens. A big reason is friction. Active strategies generate fees, taxes, and transaction costs. Every buy and sell is a small leak. Meanwhile, an index fund can just sit there and compound. Picture Dana and Riley. Dana trades and researches non-stop. Riley buys a broad index and does almost nothing. Dana might feel in control, but SPIVA suggests the long-run odds usually favor Riley's boring approach. So if beating the market is hard even for professionals, why is it mathematically hard for everyone else? Here's the 4% fact I teased. A study by Professor Hendrik Bessembinder looked at roughly 90 years of market history and found something shocking. Just 4% of stocks accounted for all the wealth creation in the stock market. The other 96% collectively matched the return of 1-month Treasury bills. That means stock returns aren't evenly spread out. They're driven by a tiny group of massive winners. Most stocks are mediocre. A few are extraordinary. Imagine Sam picks 10 individual stocks. Taylor buys the total market. Sam doesn't just need good companies. Sam needs exposure to that rare group of outliers that does most of the heavy lifting. Miss a couple of those mega winners, like Apple in the 2000s or Amazon in the 2010s, and your results can lag badly. John Bogle captured this with a simple line: "Don't look for the needle in the haystack. Just buy the haystack." An index fund doesn't require prediction. It guarantees you own the winners, because you own everything. And the math is asymmetric. A losing stock can only go down 100%. A winning stock can keep growing. Over time, that upside from the rare winners can dominate the portfolio. Now, here's the best part. You don't just own the haystack, you own a system that continuously refreshes it. Let's talk about the S&P 500. It tracks 500 of the largest companies in the United States, and it isn't static. It's market cap weighted. When a company grows, it becomes a larger part of the index. When it shrinks, it becomes a smaller part. If a company is mismanaged or becomes obsolete, its stock price falls and it automatically takes up less space in your portfolio. If it falls far enough, it can be removed from the index without you having to decide. And when a new company grows big enough, it can enter the index, and your index fund gains exposure automatically. Over time, the leaders change, the system adapts. Instead of trying to predict the future, you're hitching your wagon to human progress and letting the index do the rebalancing for you. You don't need prediction, you need participation. If the data is so clear, why do people still try to beat the market? 2 reasons: ego and entertainment. We're conditioned to believe hard work produces better results. So if you spend 40 hours researching, your brain expects a better outcome than someone who spent 0 hours. And trading can be entertaining. Watching a stock you picked go up 10% in a day feels like a slot machine win. But wealth building isn't supposed to be thrilling. It's supposed to be repeatable. Here's the recap. SPIVA shows most active managers fail to beat the benchmark over time. A tiny fraction of stocks drives most long-term wealth creation. Index funds give you broad exposure and automatically tilt toward the winners as they grow. In investing, embracing the average consistently can lead to extraordinary results over decades. In the next video, we'll talk about how account structure and taxes can quietly drag on compounding and what tax-aware investing looks like in 2026 without stock picking. If you want that, consider subscribing. And as always, educational only, not financial advice.